So I saw in an article that a weaker dollar and easing treasury yields are making gold attractive again. And yeah, I gotta agree. It's pretty attractive. So gold jumped back into the 1800s. And even though it was only a few percentage points of gains, there's this psychological bump. So welcome back. The reason for these moves are almost silly. The price moves the last few days have tracked Janet Yellen's statements. She was talking about interest rates needing to go higher, and she isn't even part of the Fed at this point, but her talking about interest rates was all it took to send the price of gold down. Now, there's a little bit more going on than that, of course, but when she walked some of that back and took back some of that talk about interest rates going up, saying that it was more of a recommendation, well, then we saw the prices shoot back up a few percentage points. Now, nobody likes to think that one condition or one person can affect the price of gold globally, but here we are. She's like the Elon Musk of gold, except when Janet Yellen talks, prices drop. Now, if you're buying for long term, a move up a few percentage points really doesn't make a whole lot of difference. But we finally broke back into the 1800s, and like I said, there's a psychological effect there. And I'm sure it'll trigger the hype train again. So we'll see that standard formula where the price shoots a little bit, news sources hype it, and then people buy in on the top of the price bump. And if you look at really any market driven by hype, which is pretty much any market other than precious metals, that's how it works. Again, price of the asset moves up, hype train starts yelling that the prices are surging, and then more people rush in and buy. Now, the problem is that typically by the time that we recognize that the prices are making a move, it's too late to benefit from that particular move. So most people buy at the top of the bump. Now, the ideal is to already have the asset. In other words, to buy it when the prices are lower so that you can take advantage of that move up. Now, if I jump in my time machine and go back to 2011, right before that run up in the price of gold and silver, I had already made a few purchases. I've told you about some of those 20 francs roosters. I'm not going to get into that right now, right here, but my very first 1 ounce gold coin was a Canadian maple leaf. Looked a lot like this one. This is not the specific coin. And it was definitely a big purchase for me. At the time, I was pretty new to gold and I was not buying regularly. So after making a few of those purchases, I kind of sat back and watched the price shoot up. I was pretty tentative about the whole thing in 2010 and 2011. So I didn't get sucked into that buying frenzy, but I definitely got excited about the price jump. Now at the time, the main reason I wasn't buying was just that I wasn't quite comfortable with the price of gold yet. But I knew a few people coming in, and I knew they were buying very heavily because that price activity, there was just blood in the water. And a lot of people come into metals based on that exact thing. Price going up increases interest. It's not a bad thing. It's actually really difficult to find the perfect wave to come in on, and very few people have the discipline to buy things when nobody wants them. We can't all be Warren Buffett. Sometimes you just have to kind of get in and do what you can with the wave that you can catch. I also got to see the prices dump in 2013. And watching the price of gold for 12 years now has trained me not to get too caught up in what gold is doing at the moment for two reasons. The first is what I've already said. People just like to hype the price increases. And if you act on that hype, you're going to be buying at the top of that particular run. That's one of those knowing is half the battle situations. What you want to do is train yourself to do the opposite and then buy on the way down. But for some reason, that just seems counterintuitive to me every single time. That whole buy low, sell high, well, that's easy advice, but it's hard to put into practice. And that leads to the other reason that I don't get too caught up in short-term price swings. I don't trade gold. And you probably don't either. So the daily or weekly swings, they really don't matter if you're buying for a long hold or even just some indefinite amount of time. It isn't relevant if your plan doesn't involve turning around and selling it for a profit, and that's advice for traders. And if you're trying to buy gold to make a profit, it's a whole other game. Physical gold, it is not a good place to speculate on price jumps because you have to beat the premiums just to make a profit. So you'd be better off trading ETFs or finding popular coins to flip. But if your primary goal is to work on building wealth in gold over time, well, the swings will average out. That's why I like the dollar cost average plan for a foundation. And then I'll make decisions on top of that if and when it makes sense. So that idea of the quarter ounce gold coin every month, that was my dollar cost average plan. I never felt burned by a specific buy, and I built up a lot of gold over time just through that consistency. And then the last few months, well, that's one of those above and beyond when and if situations because the spot price of gold dropped 17% from the highs in August up until just recently. And that drop is a pretty clear signal to be buying on the way down. Now, prices could go down further, but again, that's the right part of the trend to be buying on, even though it might seem counterintuitive. There's really no way to predict this stuff, though. I started this off mentioning that Janet Yellen's words on the economy were sending gold down, and then her revision sent it back up. But nobody knows what Janet is going to say, and nobody knows if it's going to actually matter. So what I've tried to do all along is just build slow and steady in the hope that I have the assets ahead of those price runs. And that plan works really well for something that you know has long-term value. This gold coin, it's a 2016 gold coin. It's worth more today than it was when it was minted. But that plan to buy the asset ahead of time before it makes its run, well, that's terrible advice for something like Dogecoin, where it doesn't have any value except what people determine on the fly. Oh, actually, I grabbed the 2020 coin, so ignore that part. The other coin is 2016. Anyway, Dogecoin is not something that any sane person would have been buying ahead of the price run because nobody could have predicted that run and nobody would have said that it would have long-term value, or at least not very many people would have said that. So in a case like that, you have to buy into the hype because that kind of retail frenzy is actually what feeds the price. The same goes for a lot of the cryptocurrency market. Even though some of them have utility, hype is the leading driver of their price. GameStop is another good example. That company wasn't suddenly more valuable, it was that somebody discovered a legitimate trading exploit. And the effect of that exploit multiplied as more and more people came in to exploit it. It's good to remember that gold and silver don't operate on that model, where hype creates value. It works on other fundamentals. So when the hype train is telling you that prices are soaring, the right response is to be happy the asset you already have is increasing in value, but not get so caught up that you go in heavy and buy the bump, because there isn't an exploit. Now, this video had nothing to do with silver, but that in a nutshell is exactly what has been happening with the ongoing silver squeeze nonsense. Somebody's trying to convince you that silver is GameStop or Dogecoin, but it's not. And gold isn't either. So if you want to play the value building game at the same time as the profit from hype game, it's pretty easy to do that. You just have to pick separate assets. You can buy Dogecoin at the same time that you're buying silver or gold. Now, I wouldn't recommend Dogecoin, but I did buy some for my kids and it's been fun to watch. We are officially Dogecoin thousandaires now. This is my strategy with gold and other investments though. I go steady in gold, I add to that when it's either convenient or intuitive, and then I try to get in at the very beginning of the hype with something like cryptocurrency. And I'm not saying that I got in at the very beginning of the hype on cryptocurrency. If anything, I was actually really late. I started buying more heavily last year, but what you'll see is that there are these runs. It's a very volatile thing. You'll see spikes and you'll see dumps, and the hype starts right as the spike starts. Now, eventually that game of musical chairs will end and we'll be on to the next thing. I'm not saying Bitcoin is going away soon or Ethereum is going away soon. I really don't have any expertise there, honestly. But the season for profiting from total nonsense, well, that's not going to last forever. And hopefully we can all get our capital out. Hopefully we can all get our profits out. Now, maybe you're involved in some of those wilder investments and maybe you're not. Now, my personal plan and the reason that I'm buying gold all along is to make sure that I'm doing something that builds on value rather than just buying into things that build on hype. Now, you can avoid those kind of hype-based investments altogether, or you can get in on them. But the trick is just to make sure that you're clear on which is which, not get them mixed up. And even though I'm saying that I prefer to buy gold when the price is trending down, and I try to ignore the hype on metals because that's effectively telling you to do the opposite of what actually makes sense, it's still good to see gold making a move. Now, there's always good confirmation when we see the price going up, and I'm personally happy to see gold above $1,800 again. So let me know what you think. Would you rather see gold in the 1700s, or would you rather see it in the 1800s and beyond? And then, by all means, tell me why cryptocurrency is not in a bubble. Everyone seems to think that it's going to be heading up the rest of the year. Everyone's working from that playbook. I would love to see it because I have a significant amount and they're riding it up. But I don't personally see these gains lasting forever. At least not in Dogecoin, because we can't all be Dogecoin thousandaires. And wow, that's a really weird place to stop this. We were talking about gold. And if you like the topic of gold, be sure to hit the like button because that helps get the word out. And if you haven't already, be sure to subscribe, hit the notification bell, and then share, or I don't know, just tell a friend. All of those things help support the channel a huge amount, and I appreciate it all. Thanks again for watching. I hope you're doing well. Take care.